Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here with my friend and colleague Kristian Kerr to talk all things global macro. Kristian, thanks for joining me this week. Boy, there's a lot to talk about, as there always is these days. Of course, oil in focus. So I know you brought 6 charts. I've called it around the world in 6 charts. A lot of them are certainly oil and Iran related, but not necessarily all of them. So looking forward to hearing your thoughts on where we are. So how are you this week?
Well, yeah, and macro is basically oil in Iran, so that's how we that's how we that's how we go around the horn with the macro world right now.
There you go. Yeah, certainly the S&P is related to that, and positioning is related to that. So yeah, that's the topic du jour. Clearly, it is April 6th. Hopefully, everybody had a nice holiday weekend. We're recording this middle of the day Monday, and we got a little bit of green. Here's our agenda. Stocks broke the losing streak last week after 5 straight down weeks. Of course, optimism around a potential off-ramp helped us have a pretty strong week for stocks. We'll go around the world, as I mentioned, with Kristian's 6 charts. Then I'll recap the weekly market commentary for you. It's available on LPL.com. It's a little bit more historical perspective on how markets tend to react to geopolitical conflicts. And then I've worked in an earnings study as well, making the point that when earnings are strong, stocks tend to hold up better than you might expect. And then, of course, as we always do, we'll finish with a preview of the week ahead, and we get inflation data this week. So here, first, your market recap. We had, of course, a holiday shortened week. The calendar week, we were up over 3% on the S&P. This is a 5-day look, so we are looking at a 1.7% increase in the S&P 500. Still strong. We're actually only down 3.5% year to date. So a little bit more than that conflict to date, but still pretty manageable. Stocks have held up quite well. Kristian, are you surprised that we're not down more given what's going on in the world?
Yeah, that's what we talked about, right? I think the drawdown in U.S. equities has been fairly limited, right? Given the geopolitical events that we've experienced here over the last month. I think a few reasons for that, but I think a lot of it, there's a positioning element to this that we're seeing. But I mean, yeah, if you had told me at the beginning of the year we were going to see the rotation that we saw with respect to Mag 7 losing leadership, then throw in a geopolitical event like this, you would think it would be down further than it was. So from that lens, definitely surprising. But there's 2 ways to look at this. It's either resilience or maybe complacency, right? I think that's what the market's really trying to struggle, or what the market's struggling with right now is that question.
Yeah, absolutely. You mentioned the Mag 7. That was one of the big winners last week, right? So you see that in comm services up 4% for the week. You see that in tech up 2.5%. Again, 5 trading days, not just calendar week. And although consumer discretionary was one of the weaker performers because it's so oil price sensitive, you're still seeing some of the more tech-like stuff there hold up okay. And of course, not surprisingly, when the market looks through the conflict, which it did last week, you would expect energy to be down, and it was down about 3.5%. I also think it's interesting to point out some of the international markets that have been holding up well. Of course, you follow the international markets closely, Kristian. So Japan, I know they're starting to get ships through the Strait of Hormuz. I guess they're paying a toll of some sort, but they're getting ships through. Japan's a winner. The UK is doing pretty well. Brazil as well. Any comments on any of those markets?
Yeah, no, agreed. Japan's held up very well, especially given that it's a net a net importer. But I think it goes back to the crux of the question. Is this supply shock going to be? Is it somewhat transitory, or is it going to be longer lasting? Because if it does end up being longer lasting, then I think those markets are vulnerable. But to your point, markets last week were looking through some of the negative elements and focusing more on the positive, and in that type of environment, the countries that are arguably more exposed, you'd expect to do well, right? Which I think we saw last week.
Yeah, you've mentioned Brazil needs refined product, but they do have more natural resources certainly than some of the Asian countries.
Yeah.
So there are other factors to consider, like an election, but that market certainly makes some sense that they would be somewhat insulated. So let's move on and look at bond market. So you see here the ag over the last 5 days, the Bloomberg ag bond market benchmark was up 0.8%, really strong, actually. So rates have come down. It's interesting that even though oil was up sharply, that stocks were up and bond yields were down. So your thoughts on that, Kristian? Is that just take the oil market a little bit longer to adjust, and the rest of the markets can be more forward looking?
Maybe. I mean, I think there was an element when the conflict started in the Middle East, going back to, it was a lot of it driven by positioning, and I think there were a lot of bets in the bond market going into that for lower rates. You had a lot of steepener trades that were put on. I think you saw those get unwound, and that kind of caused this dynamic of the market probably getting a little bit more hawkish than it really was. So I think that's been a big driver of what's going on in the rates market. We've sort of seen that normalize here from a positioning standpoint. So that's kind of my main take there. I mean, I do think last week, it was interesting, given that we had payrolls data on the day when markets were effectively closed. Interesting print, right? Because obviously on the headline number on the surface was a big beat versus consensus. But then when you kind of looked into some of the data, big negative revision. Labor participation was the lowest since 2021. A lot of the jobs, you could say, were kind of workers that were on strike that came back. So a little bit of everything for you if you're looking at those numbers. But I think what it did is it makes things a little bit more complicated for the Fed here, and kind of what we saw in the market was kind of this idea of pushing back when the next the next segment of rate cuts is going to be coming, kind of starting to see it kind of get more back halved. So it kind of just makes things more complicated for the Fed, but certainly some interesting things, I think, over the next few weeks. We've got the inflation data obviously later this week, which I think is going to be really important for the bond market, and seeing whether what's going on in the Middle East is starting to lead towards more inflationary pressure. So big week ahead, I think, for rates and bonds.
Yeah, and certainly Powell being a little bit dovish last week in his speech contributed to the bond market gains as well. The ag now back to break even year to date. So even though you're down a little bit on stocks, you're not down on bonds. So here's the S&P 500 chart. I know you have a different look on this in your 6 charts, Kristian, but I mean, we're just waiting for this test of the 200-day moving average. We were 60 points away on Friday. Now we're a little bit closer.
Yeah.
But not quite there yet. I don't know if you want to comment on this specifically, or you want to wait until your chart here in a couple slides.
Yeah, kind of been saying this for a few weeks now, but yeah, below the 200-day, not a great place to be. So it wasn't lost on me that when we did rally, or the rallies that we've seen have kind of been failing when we get there, we'll get really close to there. So I think you want to see that level taken out to at least start confirming the idea that there's a more sustainable low in place. But I think watch the 200-day. Probably need to get through it here relatively soon to kind of keep the momentum going on the upside.
And we haven't seen the capitulative selling that certainly you and Adam Turnquist are looking for, to suggest that maybe the risk reward is good enough to just go in even without that breakthrough above the 200-day. So So yeah, we're kind of in no man's land technically. So let's get to your six charts here, Kristian. We'll start domestic, I guess, with positioning here. So this is combined positioning, so it's institutions and retail, right? And it's really not that negative, which might
Yeah.
surprise people.
Yeah, that was kind of what I was trying to show here is, there's this question in the market, uh, given all the events of the past month, the market's held up really well. And kind of I was saying at the beginning of the call, there's kind of two lenses you can look at this through. One is the market's acting very resilient. Not lost on me that we're seeing kind of earnings expectations, earnings estimates move up right during the last few weeks when this has been going on. So that's kind of one view, the more optimistic kind of take on things, and the other one is that as this lack of supply starts to be felt, we've had a lot of boats that were kind of still in transit, and they've all reached where they were going now. That as kind of this lack of supply becomes more real, that we need a more capitulatory type event before we get a low, and really what the positioning data shows is that relative to the data, relative to similar instances over the past call it 15 years, it's been relatively muted, right? We were at somewhat elevated levels at the start of this, coming off that big rally from the April tariff stuff last year. So we've seen kind of a fairly decent kind of de-risking, but we're only right around neutral right now, and really where positioning kind of tends to be useful in terms of giving you a really good risk reward entry point is when you're kind of sub, call it 1.5 standard deviations, 1.5 z-score, -1.5 or below, right? And we're nowhere near that. So that's kind of been the issue. If you look at positioning, you look at technicals, like I do, is you kind of want to see us get to levels that are quite a bit lower than we are now. Not saying that we can't bottom from these type of positioning levels, but kind of the really strong signals tend to be from a bit further. So, that's the question. Do we need to see a little bit of a positioning cleanse? Do we need to see a little bit more fear in the market first? And that's really what we're trying to figure it out here. But again, if we were to get back to the 200-day, maybe this is all you need to see from positioning or a de-risking standpoint. But I think we need to see that first before you can even start making that argument. So right now, a little bit biased that we probably need to see a little bit more of a de-risking episode before we can kind of make the all clear or saying that the risk reward is favorable to start kind of getting back into equities more aggressively.
Yeah, definitely have not seen the washout. Not even close, really. All right, next chart, S&P 500. I alluded to this, that you had two looks at this. This one goes back to 2019.
Yeah.
What's your message here when looking at this longer term uptrend on the S&P?
Yeah, kind of just wanted to zoom out a bit and talk about kind of where we are. I think the low that we had in March of 2020, big low, you can make the case that's really where the kind of the broader term bull market started, and we're still we're still well within kind of an upward sloping trend, right? Every time we've kind of tested the bottom end of this channel, this slope, we've held it. So longer term, still uptrending, still positive. So typically you want to be looking to get exposure to the uptrend on pullbacks. I think the intermediate term trend has shifted, and that's what we've talked about, going below the 200-day. So that's that red line, still sloping higher. So you can make the case that the intermediate term trend is still higher, but the fact that we're below it is clearly a warning sign. So we've kind of got intermediate term trend potentially shifting, long term trend higher. So if you look kind of at where we are, like I would say kind of the big levels from a if we were to get further selling, further capitulation, it would be kind of those old highs from late last year, or early last year, late 2024, right? Kind of the levels that ended up starting the decline into the Liberation Day episode last year. But you'd want to see, we got down there us hold that, right? But that's going to be the natural level, I think, to watch. And the reason I wanted to flag that is if you go back to last year during the April tariff stuff, that's precisely where the market bottomed, was against those old highs from basically 2021, 2022. So that tends to be a pattern that you see. So that's kind of, if we are going to get another leg down, I think that's the first real test for the market. But I think, overall, it's very easy to get kind of caught up in the short term, and really just wanted to show that we are still in a very kind of strong longer term bull market when you zoom out. And kind of the way I think to approach that is to look at it from, okay, when you get drawdowns into those types of advances, where do you start looking for places to kind of re-enter, increase exposure? And I think that first test is going to be those old highs from late last year, late 2024, early 2025.
Yeah, and
Kind of
that's
the
kind of,
low 6,000s.
yeah, I was just going to say 6,100, 6,150,
Yeah.
kind of in that range. We've highlighted for other technical reasons as a place this might land. You think it might even be a little bit lower than that?
Could be. I put in that, if you look at this, so, if you think about a slope, it's kind of just the gradient that the market tends to respond to. And you take some of some of those prior lows from 2024. Clearly that slope has been driving things even outside the outer boundaries of the channel. So that line comes in a little bit lower. So I think somewhere in that zone, kind of the low 6,000, 6,150 down to 6,000 is kind of the level you'd expect to see the market respond. And if we kind of get there and then you don't hold it, that's telling you something as well. So a lot of it's like how you react when you get there. Now, on the flip side, not saying that we have to go down there, right? I would argue the positioning chart I showed before, there's still a fairly good chance that has to happen. But if we were to kind of turn around here, get a multi-day close above the 200-day, weekly close above there, then maybe that's all we're going to see on this decline. I mean, it was almost 10% from peak to trough, so maybe that's enough. But from a purely technical lens, where you want to kind of see the market go and test kind of a big support level. The really big support here is going to be that 6,150 to 6,000 area. And if we were to get down there, that's where I think you need to pay extra close attention to how we respond to such big support.
Yeah, probably need another disappointment in the Middle East to get there. But the flip side is you could certainly have an off ramp or a ceasefire become apparent in the next week or two, and then maybe you go right back to the 200-day and break through it. So yeah, it's a combination of news flow, fundamentals, and technicals all together. It's clearly a muddled picture. Of course, oil is still calling the shots, as you say here. Kristian, this is the volatility of oil, not the price of oil.
Correct.
You talked about this a number of times as something to watch. Doesn't look like we've really had the breakdown that we want to see here.
Yeah, and that's kind of the main point. I think I called it the last time we did this call, the chart of truth. Mm-hmm. And the idea here is that, so think of it kind of like the VIX of oil, right? And I think the last time we were getting right up to the highs from 2022 when Russia invaded Ukraine, and kind of the idea was we're in this mono-factor market, singular focus market, which is what's oil doing, and that's going to continue to generally drive market movements. And we've been seeing that, and really I think you need to see this get below the extremes from 2022 and start to settle below those levels. And right now, we went quite a bit above those levels, and we backed off, but we're still kind of consolidating above those extremes. So I think you can't really call an all clear until you start seeing kind of the volatility of oil start to pull off quite a bit more than where we are now. And say we start getting sub 80, sub 70 in this index, and I think and start kind of staying there for a little bit, then that would be kind of the first material sign that we are starting to get an environment change, regime start to shift, be less about oil. And maybe some other factors start to drive the market. But until we see that, I think what's going on in the Middle East, what's going on in the oil markets can continue to be the primary driver of equity market movements.
So yeah, when you price this, it was 95. The high in 2022 around Russia's invasion of Ukraine was about 80.
Yeah,
So even though we've come down, we're still above that 2022 high, and have a ways to go to break below that. The stock market VIX, I think, tells a similar story. We're not quite into that cool down zone, a little bit elevated. Really want to see both the oil VIX and the stock market VIX
yeah.
to break below prior highs. So thanks for that, Kristian. Let's keep going on the oil theme. So I was encouraged to see some ships get through the strait, although certainly they are paying tolls, it appears. I saw ships to India getting through, Japan getting through. Those are biggies. We certainly weren't surprised that some China ships got through, but yet the overall count is still pretty low.
Yeah, I think it was 21 over the last 3 days. Um, and then who knows? Maybe some are running the gauntlet as well, right? And doing it with their trackers turned off. So, but bottom line, this number I'm showing here is probably off, but still well below the averages. And really, what I want to show with this chart is this is what's driving things, right? The markets want to see an end to this, traffic starting to pick up, within the Strait of Hormuz, and right now we're kind of far off normalized levels. Certainly positive that we're starting to see some ships get through, but a lot of that seems kind of token for the time being. But I think what the markets want to see is a resolution, one way or another, where there is molecules getting out, supply going to where it needs to go. And, again, the longer this kind of draws out, there starts to be more and more knock-on effects. So we're starting to get into kind of crunch time, to where we want to start seeing kind of this chart ticking up, and getting back towards more normalized levels here.
Yeah, we're at the roughly the end of the 4 to 6 week time frame that Trump gave us when this started. So, and certainly everything he said recently suggests that he expects this to come to a close here fairly soon. So it'll be interesting to see what the strait looks like after that off ramp, whatever it looks like. But yeah, clearly we're not near the 80 plus ships a day pace that we were at before February 28th. So we'll keep watching the news like all of you. So, all right, next chart is a prediction market look at how likely the strait is to be open by June 1. And this percentage, at least based on Kalshi, is pretty low.
Yeah, and that's what I wanted to highlight. A couple things here, but one really is that there is a lot of room for a big portion of the market to get this wrong, right? And that's really what I'm trying to highlight here. And this first chart shows, it's the prediction markets, and they're basically saying there's a 1 in 3 chance that we're going to not even normal traffic, but a little bit below average traffic by the start of June. So there's a big part of the market. And again, how much money is really in these contracts? It's relatively low, but you can make the case that they're useful, because if people feel that strong, they're actually putting hard-earned money into that there's a usefulness to that, to having that information. But basically we've been hanging around the lows. If you look at some of the same prediction markets on when there's going to be a ceasefire, basically roughly a little bit less than a 1 in 5 chance last I looked, by April 15th. So not a lot of optimism in the prediction markets. And I think, if we do get a resolution, then, there's a lot of people that aren't thinking it can happen in a short-term timetable. So that could be a pretty big catalyst for some upside across, equities and cross asset, right? So that's just what I wanted to highlight, that there doesn't seem to be a lot of optimism in the prediction markets. But if we go to the next chart, this is where there does seem to be quite a bit of optimism, and that's in the longer dated futures contracts, right? So one thing to know about how kind of oil works, or commodities work in general, is that you've got a futures contract, which is delivery on a certain date at a certain location, and Brent Brent crude is more important because they're kind of the ones that oil is more impacted by what's going on in the Strait of Hormuz. But what I found interesting is that, so you look at what's going on in the prediction markets, they're saying, not a very high chance of supply coming to the market, or the Strait of Hormuz getting opened up. Yet you look at Brent crude futures, and December of this year, it's only trading around $79 as of last week, right? And that's telling you that they don't think this is going to be a long lasting issue, because they would be trading a lot higher, right?
Mm-hmm.
So you've got kind of this,
Great point.
so you've got kind of this element of, there's a lot of people in the market that are quite negative, but then the actual commodity itself has not responded the way you would expect if there is going to be a long-term supply issue in the crude market. So that's kind of what I want to just highlight, is that there's a lot of uncertainty, and you look at a lot of these things, it's basically a 50-50 flip of a coin type of thing is where we're at. And you've got a lot of different markets saying different things, which tells you no one really knows, right? Because if the Brent crude December contract is wrong, this is going to go, we start having supply issues, is going to go a lot higher, right? And likewise, if the prediction markets are wrong, then this probably goes quite a bit lower from here. But I just wanted to flag this. I thought it was a very interesting chart, in the sense that typically, longer dated contracts and short dated contracts tend to trade pretty closely with each other, and they're starting to diverge quite a bit. So again, this market is telling you that they're not so certain. There's a big supply issue. It's going to be long lasting. So a positive in terms of what's going on out there right now.
Yeah, for the wonks out there, I think you call this backwardation, right? When you have a cheaper long-term contract. So that's a really great point. We get asked, I'm sure many of you are wondering, why is the market holding up well? Why aren't we seeing higher yields in the bond market in response to this higher oil and higher inflation and all that? Well, this is your answer. It's as simple as that. The market doesn't see this as a long-term oil disruption. So great choice of charts there, Kristian. Thanks for bringing that to us. Let's move on to the weekly market commentary, and then we'll preview the week ahead. So I did this on historical perspective, not just how do stocks do in geopolitical events, but also how do they do when earnings growth is really strong. So first, I narrowed down the events. We had 25, 26 geopolitical events in our last study. I just narrowed it down to only wars and significant military engagements, which I think is certainly more comparable to what we're experiencing now. And you see here, the message is the same. The average drawdown during these events is only 7%. We just got 9, but 7 is certainly a pretty manageable drawdown in the S&P 500. And then you recover those declines within about 50 days. So you see here, the vertical axis is the number of days to recover the S&P 500 decline. Look at how low these dots are, right? You get a little bit above 50 when you're talking about the breakout of the Korean War, but it's basically Iran, Kuwait, 1990, and Pearl Harbor, where it took longer. So, it goes without saying that this isn't Pearl Harbor. And then we don't think this is Iraq, Kuwait either, because that was a much bigger disruption to energy markets, and it was a recession anyway, right? We were headed for recession regardless. That just sort of was the last straw. The economic environment, the economic foundation is much stronger today. So we think we're going to be kind of one of these low dots when all the dust settles, certainly where you want to be. All right, next chart is just double-digit earnings growth years against annual stock market returns. Okay, so thank you to Evercore ISI for this concept. Their equity strategy team and Julian Emanuel gave me the idea. So you take double-digit return or double-digit earnings growth years on the x-axis against your total return that year on your y-axis, your vertical axis. You can see here we're up. This shows 10 out of 12, I believe, but we left 2003 off because the earnings growth was so strong, it would have distorted the scale. But you see it in the footnote, earnings growth was over 300% that year. So that counts though, because stocks were up. The down years are 2000 and 2018. 2000, of course, the market started pricing in the end of the .com boom, the bubble bursting. And then in 2018, the market was worried about a Federal Reserve policy mistake, right? That was kind of round one of the Trump-Powell battle, which I guess Trump won that one. But at any rate, we ended up recovering all those losses from that policy scare in late 2018, because 2019, the S&P 500 was up about 30. So we don't think we're bursting a dot-com bubble. We don't think we're going to have a near bear market because of fears of a Fed policy mistake. Therefore, we would expect stocks to be higher this year and fit with one of these higher dots where you get double-digit earnings growth and you get higher stock prices. So bottom line, earnings are still relevant, even though nobody's really talking about them. And if we do get this double-digit, actually consensus is 17% now. We'll talk more about earnings next week, probably. But 17% earnings growth is consensus. That certainly is strong support for stocks to go higher. So that's in the weekly market commentary on LPL.com. All right, back to you, Kristian, for previewing the week ahead. I think inflation is the most interesting economic data point to watch, but we did just get the ISM services data, which was interesting. What should investors be paying attention to this week?
Yeah, I think it's going to be the inflation data, starting Thursday with PC, but I think Friday is going to be the big one, and I think market's going to be looking for even the slightest sign of the Iran war, and related energy price spikes, so they're starting to pass through to the economy or not. So I think that's going to be the big thing to watch this week from a economic standpoint. Obviously, whether we have this hard deadline from President Trump in terms of getting a ceasefire or not. So obviously that's going to be probably the real driver of everything this week. But yeah, definitely going to be watching the inflation data later in the week.
Yeah, no doubt. The ISM services prices paid index was higher than expected and jumped quite a bit, 7 points month over month. So that's certainly going to contribute to a little bit of inflation anxiety heading into those reports. Of course, importantly, the PCE data, which the Fed thinks matters more, is February data. So that will not include the conflict in Iran. The CPI on Friday does. So that will be much more interesting and get a lot more attention. I think the month over, I'm showing year over year here, 2.7 core. I think the month over month headline is probably going to be up close to 1%. That's a big number. But again, we're going to look through it. What matters is what happens in the Strait and getting oil through and getting to a ceasefire. So agreed, that'll be what everybody's watching most closely, as has been the case since the start of March. All right, I think we'll wrap there. So thanks, Kristian, for joining. Thank you to all of you for listening to an LPL Market Signals. Hope that was helpful and engaging. We'll talk to you next week. Everybody have a great week. Take care. We'll see you then.
See ya.